I'm Carl Mercurio with Healthcare Week in Review. We're here with David Snow, who's the Chairman and Chief Executive Officer of Medco Health Solutions. Medco is one of the nation's top pharmacy benefit managers. David, thanks for joining us.
No problem.
Well, you guys had a great week last week. Shares in the company were up 10% after you announced that fourth quarter earnings beat Wall Street expectations. You raised your profit projection for 2007, and then you said in 2008, profits would be up at least another 20%. Well, by my calculations, that's more than 2 years' worth of good news, all crammed into one press release.
That's right.
What's driving all the positive results at Medco?
We've been very focused on a strategy since we took the company public in 2003, and we always have had confidence that that strategy would bring real results. And, the key drivers to our success are our sales have been phenomenal. Our net new sales this year were $3.3 billion. The year before it was $3 billion, so that's certainly fueling our growth. Generics are a huge positive, and that will continue through 2011. We just bought Accredo in 2005, which is our specialty business, and now we're the biggest specialty business in the country, and that whole space is growing at about 34% on the compound annual growth rate. 34% is huge. Medicare Part D, big contributor. So we have a lot of nice drivers that are fueling our future growth.
One of the things that everybody's interested in is the potential effects of a merger between drugstore chain CVS and Caremark. Now, you made some very interesting comments on your fourth quarter earnings call with Wall Street analysts, saying that since that merger was announced, Medco has actually seen more favorable pricing from drugstore companies that compete with CVS. Maybe you could elaborate on that. Why do you think drugstores are more willing to play than ever before? And also tell if you think there are other opportunities along those lines for you to operate more efficiently and more competitively.
Yeah, basically what's happening, I'll give you a concrete example. The only big account we lost in 2006 was Daimler Chrysler. We actually lost it to the PBM of CVS. And all of the other retailers have seen that since CVS has taken over, the retail business has started to move away from the other retailers over to the CVS retail stores without cutting them out of the network. Mm-hmm. And they understand that all of a sudden you've got a new alignment that will try to, it really is a threat to their business. So they see us as a neutral player who really will not have that kind of favor. It's all about the best price for our clients, but there isn't a built-in reason to pull the foot traffic out of their stores. So I think they see us as a better partner in delivering value to our clients. And I think that's a great position to be in.
That sort of gets at my next question is Medco at one point was owned by a drug company, and there were many conflicts involved in that relationship, including having to push the drugs of the owner, which was Merck. You came in and did a very good job of sort of severing those ties and cleaning that up. One of the questions involving a possible merger between CVS and Caremark is that conflicts will arise again. Did you learn anything as an organization and as an executive when you severed yourself from that prior relationship that might help you in this new environment?
Yeah, I mean, that's a great question. First, let me be really clear. It was the optics of the ownership. Actually, when I came into Medco, they really did a very good job keeping the drug company separate from the PBM. And the clients were never disadvantaged because of that relationship. But optically, there was a concern it would. So, sometimes optics can be reality when it comes to your brand. So I am hypersensitive to perceived conflicts of interest, whether they exist or not. My view is that a combination between a PBM and a retailer isn't as bad an optic as a manufacturer. Nevertheless, there are certain customers who are going to worry if you own the retail channel, whether or not you're still serving their best interest. There's always that danger. I can't say it will be prevalent, but it always exists.
The PBM industry in general seems to be in pretty good shape. I mean, you've gotten good gains from generic drugs where you make most of your profits. You've got Part D driving growth. But one of the things that I noticed in just looking across the board is that script volume has been increasing but at a declining rate. Is that a concern? Should investors be concerned about that as a long-term sort of problem for the industry? And I guess it gets at the question of whether this is a zero-sum game. The only way to win is to win business from others, and if you have to do that on a price standpoint, it gets at profitability in the long term.
Yeah, I mean, I would say they absolutely should not worry about that. Mail channel is a very popular channel. It does continue to grow for us specifically. I'm always quick to point out that in 2004 we lost FEP which was our biggest mail account. It was 10 million prescriptions at mail. We made up those 10 million scripts the following year, tied to new business sales. The reason it looks as though our rate of growth has slowed down is that since that time, we've sold, I think, 7 new state accounts, all of which are very heavy retail. And we consider that great business because all of them except for one do favor mail in terms of how they've priced because it's cost advantageous to them. And we're great at moving to mail. So you're going to see that start picking up again. We had to make up for the losses of a couple of heavy mail accounts, FEP specifically or Daimler Chrysler. So we're very optimistic about it.
Finally, you said that you were dramatically increasing your share repurchase, I think $5.5 billion over the next 2 years. And you also said that the company is not in the market for any major acquisitions. Now, the Wall Street guys are a little skeptical of that. They think that under the right circumstances, you might pull the trigger. Certainly, your capital structure is good. You have a lot of flexibility. Is it a strategic thing at this point that you wouldn't make an acquisition, or is it more that you just feel you're in a good position right now and you don't need to make any major moves?
What I've tried to make clear to our investors is that our organic growth on a standalone basis is very strong, hence the guidance we gave beyond the 07 year. That's not typical for us. We want to make absolutely certain we focus on those opportunities. The growth is very strong and our shareholders benefit tremendously. But I would never say we are never in the market. It's always, there are lots of variables in play, but at the right price, it would make sense for shareholders. So we are always evaluating continuously, and we'll see. Things change every day.
Great. Thanks very much. From the Medco Automated Drug Dispensing Facility in Willingboro, New Jersey, I'm Carl Mercurio.